Today, APRA leads the Banking Preservation Society. Hello again, it's Martin North from Digital Finance Analytics. Welcome to his post covering finance and prop news with a distinctively Australian flavour. Well, today we have further confirmation that APRA is only interested in preserving the banks and is not very interested in broader questions like home prices or indeed individual lending to borrowers. This, of course, is consistent with the proposed changes that the government are trying to push through with regard to responsible lending. And in today's evidence given before the Economics Committee, Wayne Byers and his team spelled it out.
There's obviously been discussion around increase in house prices and what's happening around borrowing obligations. The Reserve Bank has said rather than dealing with it through monetary policy that they would seek to address the rising level of debt and house prices through prudential obligations on banks and lending capacity. Could you give us an outline, firstly, on what you intend to do in this space in terms of guidance for banks? But secondly, that if house prices, your reflections on if the house prices continue to rise, young Australians find it harder to save a deposit more than ever, at least because 10% of their income is taken away from them, put into locked away for 50 years. But then in addition to that, you make it harder for people to access cash, credit, I should say more correctly, that what we'll actually see is a housing market which advances the interests of those who already own a home, but essentially lock out first home buyers.
Thank you, Chair. So I'll probably start just by clarifying the way you paraphrased what the Reserve Bank said, because I think the bank has been very clear, and we've certainly been very clear as well in saying our job is not to set or seek to target house prices. I've repeated that many times over the years when there's been debate about housing. It's not our job to solve house prices, not our job to solve affordability. What we have been watching, though, and as you would expect us to be watching, and our fellow regulators at the Council of Financial Regulators are watching, is the extent to which there's a dynamic emerging of increased risk-taking by the community and by the financial sector. At this stage, that's not evident. Clearly...
Sorry, can you just clarify this? That's not evident. Just clarify exactly what you mean by that.
Yes, so I think if you... I think the last statement by the Council of Financial Regulators said quite clearly we were watching for deterioration in lending standards.
Yep.
But that's not evident at this point. That's not to say it won't emerge, but it's not obvious at this point. So clearly the issue is one that we're watching, as I said, with our fellow regulators at the bank, at Treasury, at ASIC. It's something to keep a close eye on because housing is a big part of the balance sheet of the banking system, and making sure that it's a stable part of the balance sheet of the banking system is important. But I just want to be really clear that it's not our job, and it's never been our job, to solve the problem of rising house prices.
Okay, but can we just clarify, just in a very succinct way, if we were to find ourselves in a situation where house prices are higher, which means you need more of a deposit and more credit, and you restrict credit, it is likely that unless you already own a home, so you already have capital at your disposal, it will make it harder for young Australians to be able to get into the market, both because of the increase in deposit requirements and on top of that, the increased obligations in order to access capital. Do you see that as a realistic proposition?
Well, I think as a hypothetical, if you restrict credit, then people find it harder to get credit. I think that's pretty pretty
And
hard.
it largely favours capital interests who already are entrenched and have capital.
Well, it depends how you restrict the credit, but in all likelihood, yes, I think the sorts of outcomes you're talking about could well come to pass.
This is a very worrying trend about where things are heading. But I'll hand it over to the Deputy Chair.
Thanks very much, Chair. And
Sorry, for 25 minutes, so till 50.
Lovely, thanks. Thanks very much, Chair. I wanted to start, Mr. Byers, on the issue of responsible lending laws. Can you just outline the current penalty regime for breach of responsible lending obligations?
I'm not sure I can, because they're administered by ASIC. So that part of the Act, the Credit Act, is administered by ASIC, and I confess I don't have, certainly at my fingertips, I don't have the penalty regime, because it's not something that we apply.
Well, my back of the envelope research puts it at penalties going up to 10% of annual turnover, capped at 2.5 million penalty units, which would mean a maximum of 555 million. So currently, if an Australian bank was found to be irresponsibly lending money to a group of vulnerable people, they could be hit by a penalty of up to $500 million. If we then move to the backstop under the government's proposal of APRA's Prudential Standard APS 220, that's got much weaker penalties, right? What are the civil penalties for institutions who breach APS 220?
Well, in the first instance, Deputy Chair, there are no penalties for a breach of a prudential standard, of any prudential standard. If there is a breach of a prudential standard, then the first course of action for APRA is it enlivens a power for us to issue a direction. So then if the institution was found to have failed to follow the direction, then it would be possible to go to court and seek some sort of rectification and sanction for that. But the first step of a breach of prudential standard is it enlivens the directions power.
So there's no penalty for a breach of 220, no civil penalty, no criminal penalty?
No, and that's because these are prudential standards made by APRA, and so there isn't. We have the power to make the standards, but they don't come automatically with a penalty attached.
And what about an individual who's hurt? Can they take the bank to court?
Well, an individual can always take a bank to court on any matter, but
not under APS 220, is it?
Oh no, not under APS 220. The main rectification at present in the regime today, as well as in the regime proposed by the government under the reforms, is that an individual would go to AFCA to seek to have the issue dealt with, and AFCA has the power to ensure that the individual receives remediation and compensation if that is warranted.
But go to the Ombudsman seems pretty weak, right? I mean, AFCA is not a law enforcement authority. I guess my broad point is that, as a note from the law firm Allens has observed, one of the great weaknesses of the government's proposals to water down responsible lending obligations is it takes away a consumer's statutory right of redress.
So, Deputy Chair, I think all I can say is these are obviously government reforms. We can only just say what APRA does. The current role for APRA and the future role for APRA, if the reforms pass Parliament, are essentially unchanged. We do not have new responsibilities. We keep doing what we're doing with, by and large, the same prudential standards. The extent of the government reforms is, in a sense, outside of what APRA does and will do.
might not have big implications for you, but it's got huge implications for vulnerable consumers. At the moment, there's a civil penalty regime with a $500 million fine. Under this new regime, we move to a system in which consumers can go to the Ombudsman, who doesn't have the legislative powers to investigate breaches or to pursue enforcement actions, or else they can hope that APRA will do something, but there's no direct penalties associated with a breach of the relevant prudential standard.
So I make two comments. Again, recognising that this is not really, the changes being proposed by the government are outside of what APRA does. But AFCA is more than an ombudsman. It has been instituted with much more forceful powers. It can impose rectification and binding rectification on banks to deal with customers who are deemed to have been dealt with unfairly. And that will include, if need be, financial compensation for individual customers. So that's the primary means by which an individual with a complaint against a bank would be addressed. AFCA also has a responsibility, and this perhaps goes to your concern, but AFCA also has a responsibility where they see matters that they consider to be systemic within a particular institution. So it's more than, for example, an isolated complainant, but there seems to have been a pattern of practice or a breakdown of controls. They have an obligation to report those to us, and we would obviously have the opportunity to look at those. If we felt there was a breach of the prudential standard, or more generally just a breakdown of controls that was leading to poor lending, then obviously we can have that issue rectified. We can use our other powers, such as capital penalties, etc., to provide the right incentives for the financial institution to do the right thing. But again, that's what we can do today. Our role is not changing under the responsible lending obligations that are proposed by the government.
But let's not oversell the job that AFCA can do. I mean, they're a private company limited by guarantee, authorised by the government to provide dispute resolution for disputes between customers and banks. It's a pretty poor substitute from having a proper enforcement watchdog, isn't it?
As I said, Deputy Chair, I think I can really only comment on the role that APRA is playing in the framework. But my observation is that AFCA has been very effective in its life so far in making sure that consumers who are feeling they've been treated unfairly have been looked after.
APRA testified at Senate estimates last week in response to questioning from my colleague Jenny McAllister that you wouldn't pursue or prosecute individual cases of irresponsible lending for mortgages, credit cards, or personal loans. Is that really your position?
That is our position, because we don't really have the powers or the mandate to pursue those things. As I said, if there are issues that require rectification and compensation for consumers who have been dealt with unfairly, AFCA is the vehicle by which those issues are heard, determined, and, as I said, where necessary, compensated.
So ASIC would be losing the function, APRA wouldn't take up the function, and the response is essentially go to the Ombudsman, who lacks many of the investigatory powers that ASIC and APRA would have. I mean, for an individual borrower who's sold an unaffordable loan, they can't take the bank to court, and they've got two regulators who then say that they're not available to assist them. You've got penalties going from $500 million to zero. Surely in that environment, it's going to be much more attractive for financial institutions to engage in irresponsible lending.
And this gives us further evidence to suggest that APRA should be disbanded, its responsibilities rolled back perhaps to the Reserve Bank, and the responsible lending rules should not be removed, because if they are removed, borrowers will be taken to the cleaners. The prudential regulator also revealed that the number of borrowers who elected to pause repayments had fallen from around $260 billion in loans were frozen. APRA Deputy Chairman John Lonsdale said the regulator would release data for February later this week, showing a sharp fall in the number of frozen loans ahead of the March 31st end date for the concessional capital treatment of such borrowings. Lonsdale said the regulator remained alert to the changing environment as government assistance was withdrawn, but it was largely positive about the outlook. We had around 10% in May, Lonsdale said. The data we will release this week will show the amount has been reduced to around 0.5%. That's a very good news story. The vast majority of people on deferrals have now been reduced. But let me underscore again a couple of things. The first is that APRA continues to confirm that it has no interest in individual borrowers and whether they are actually borrowing too much or too little. That, of course, is a consistent theme that we've seen. That, of course, at the moment is ASIC's responsibility, but under the responsible lending changes proposed by the government, that would be switched away. And APRA also sort of tried to deflect responsibility onto AFCA, but of course AFCA can only deal with a complaint after a loan has been made and goes wrong, which means that, again, borrowers will be exposed if the responsible lending obligations were changed. You can watch my recent show on that. Now, elsewhere, John Authors at Bloomberg has suggested we are looking at the US markets all wrong. Rather than being at the start of a new bull market, which of course started back in March after the drop, we might actually be in the very last phase of a long bull market. This is a chart of the S&P 500 on the log scale starting 12 years ago, and you can see the trend lines quite clearly that join the peaks and troughs, but arguably that isn't necessary. The upward trend is very clear. A year ago, in response to an external and scary risk, the market dived below the lower trend line for a matter of days. Since then, the rally has been remarkable, but perhaps it makes more sense to regard this as a recovery from the shock, followed by a climb from the bottom to the top of the market's upward trend. You could call this a long bull market, followed by the briefest bear market on record, followed by the beginning of another bull market, but it makes more sense to call it a briefly interrupted bull market. Now, there are many other examples where the extreme shock of last spring and the remarkable measures that followed it have messed up the normal cyclical rhythms of markets and the economy and could wreak havoc on our perceptions. That could be particularly true in the next few months, when year-on-year comparisons will show a sharp rise in inflation, which may indeed prove transitory. What we've seen in the past 12 months or so is a historically anomalous spasm that is still working its way through the economy, but we aren't in the early stages of a bull market. We're in the very late stages, and that has altogether less pleasant implications. And finally, the Victorian government has passed legislation that will allow mortgage documents, deeds, wills and powers of attorney to be executed electronically. The passage of the laws has made permanent, temporary changes that were introduced during the COVID-19 crisis, which allowed for documents to be signed electronically and remotely to adhere to social distancing restrictions introduced by the federal government. Last week, the Victorian government passed the Justice Legislation Amendment Systems Enhancements and Other Matters Bill 2021. The bill provides for electronic signing and remote witnessing of legal documents in Victoria by amending the Electronic Transactions Victoria Act of 2000, which clarified that mortgages can be in electronic form. The new Section 12B has been added to the Electronic Transactions Victoria Act of 2000 to enable private mortgages to be in electronic form. A new section inserted in the Act states on And from the commencement of Part 10 of the Justice Legislation Amendments, Systems Enhancement and Other Matters Act of 2021, any transaction, deed or mortgage signed or witnessed under this Act as modified by Part 2 of the COVID-19 Omnibus Emergency Measures Electronic Signing and Witnessing Regulations 2020, as in force immediately before the revocation, continues to be a validly signed or witnessed transaction, deed or mortgage despite that revocation. The passage of the legislation has followed the introduction of the bill in February, which, according to an analyst by law firm Allens, provides expressly that deeds and mortgages can be electronic. Commenting on the legislation and the permanent reform around electronic signatures law in Victoria, DocuSign Vice President and Deputy General Counsel Doug Luffman congratulated the Victorian Government on passing the laws that allows documents to be signed electronically. He added that the coronavirus pandemic underscored the essential need to be able to sign documents electronically from any location, any time. He said DocuSign congratulates the Victorian Government for modernising their laws for the digital age by allowing deeds, wills, powers of attorney and mortgage documents to be executed electronically. This is an important step in the government's digital transformation journey. The changes will enable businesses, consumers and lawyers to save significant costs and time in the preparation and signing of documents, particularly in rural and regional areas. As we've seen with important interim digital measures over the last year, businesses and their employees have been able to sign electronic documents in minutes rather than days, while saving on costs such as paper printing and storing documents. Such considerable paper reduction also has positive environmental impact. Luffman urged other state and territory governments to follow in Victoria's footsteps and reform their electronic signature laws to remove red tape around signing documents so that we can have a single national process that ensures accessibility, ease and secure transactions for all Australians. Luffman made similar calls last year when he told the Advisor he thought that federal and state and territory governments should be working together to create a permanent and standardised solution to the mortgage application process and the electronic transactions on mortgages. He'd argued that having the ability to sign mortgage documents remotely not only helps loans to be written remotely, but can also reduce the time taken to write a mortgage by avoiding the need to wait for papers to be sent and signed. He also built on calls by others in the mortgage industry calling for temporary changes introduced during the COVID-19 crisis around the ability to sign documents electronically to be made permanent. These included calls from a coalition of financial associations who wrote to each member of the National Cabinet to make these changes permanent, as well as from brokers who started petitions to digitise the loan processes. Adding to these calls for reform was the senior process consultant and delivery lead for commercial lending at the Commonwealth Bank, Tim Roberts. Roberts said, when COVID-19 hit, we moved quickly to embrace temporary electronic signature laws, which have greatly improved efficiency and accessibility. For example, using DocuSign to sign deeds and mortgages in New South Wales and Victoria has reduced turnaround times by 10 days. However, when it comes to signing deeds and mortgages, Australia has 8 different jurisdictions and 6 different frameworks, and a number of states are still paper-based. A national process would help reduce complexity and risk, and we encourage the other states to follow Victoria's lead so that we can have a consistent process across the country. Other lenders, including Bendigo and Adelaide Bank and Heritage Bank, have also called for uniformity in legislation that would allow electronic signatures on mortgages across the states. While some would like consistency in property legislation in all states and territories to remove complexities in addressing the different requirements of different locations, other lenders said their main barrier to digitising mortgages was the fact that legislation prevented them from doing so. Several lenders, including Suncorp and AMP Bank, introduced electronic signature capabilities in 2020, while ANZ introduced eSign to enable all of the various application forms on Loan App and Apply Online to be electronically signed via the eSign tool. Now, the point I want to make is this. The government, of course, is claiming that removing responsible lending rules will actually enhance lending processes. But the truth is that the most significant improvements can be made from simply smartening up the overall value chain and processing chain around mortgages, and e-signatures is a critical part of that. So my view is this: if in fact you really want to deal with loans more quickly and get them out through the door, you don't need to take away responsible lending support from individual borrowers. You just need to legislate away all of the stupidity with multiple different duplicated processes and systems across states using different sets of laws and processes that really make no sense these days. And in my view, using digital signatures as part of that makes perfect sense, providing, of course, adequate security is in place. So let's be clear. Removing the responsible lending obligations which currently exist and which were confirmed by the Hayne Royal Commission as being critical should not be removed. We should be focusing on elements across the value chain which can be made without reducing borrower protections. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.